I just read and read and read. I probably read 5 to 6 hours a day.
Do you know what habit every super successful investor has? They read. And they read a lot. But you don't have to spend as much time reading as they do. In fact, in this video, I'm going to tell you only about the most useful books on investing and their main ideas. Those will be enough to outperform over 90% of the investors in the market. Let's start with the Bible for those who dream to become financially independent. The book Rich Dad, Poor Dad. It explains the very concept of money and how to become rich. In this story, written in very simple language, Robert Kiyosaki shows how rich people think and act compared to poor people. Here are some key points of this book. The only way to get out of the rat race is to know how to handle your finances and invest. Until you make money work for you, you will remain a wage earner. Money without a financial education is wealth that will quickly disappear. To be successful, you have to copy successful people's habits. And the most important idea of the whole book is this: the rich buy assets and the poor buy liabilities. A poor person with $1,000 will buy liabilities like TV, entertainment, jewelry, or other things to seem rich. A rich person will try to invest the amount with the maximum return for themselves to get much more after a while. Also, Kiyosaki writes that people's most powerful asset is their intelligence and control over their emotions. And the following book will help you tremendously in working on your intelligence. Ask any successful investor to name the 2 things he regrets most in his life. One of them will definitely have to do with a particular stock that he should have bought but was afraid to, or that he sold early but should have held longer. So, Morgan Housel's book tried to help you not to make that kind of mistake. After all, the most important thing for success in investing is psychology. The psychology of money explains the most important truths and psychology in financial markets. However, it does so in a much simpler way than Nobel laureate Richard H. Thaler's books on behavioral economics. Here are a few basic points I'd like to share. An investment genius who loses control of his emotions risks bankruptcy. The opposite is also true. Very ordinary people with no financial education can be wealthy if they have some useful habits. The result in finance is strongly influenced by luck, which does not depend on intelligence and diligence. And of course, the author cites Warren Buffett as the clearest example that the truths from this book work. None of the 2,000 books that analyze Buffett's success have the title "This guy invested consistently for 3/4 of a century." But we know that this is a key factor in his success. Morgan says Buffett's success is due to his patience and control of his emotions. The most important and useful book on investing would have to be titled "Shut Up and Wait." Since we've mentioned the legendary Buffett, I'll go on to talk about his favorite book. Benjamin Graham was one of the greatest investors in history. His work, entitled The Intelligent Investor, Buffett called the best book on investing ever written.
You know, I obviously recommend first and foremost The Intelligent Investor, with chapters 8 and 20 are the ones that you really should read.
Like the previous books in this video, this one mostly teaches a way of thinking rather than technical details. So, let's get straight to the key points. A smart investor is a realist who sells stocks to optimists and buys from pessimists. To remain such a realist, don't make impulse purchases and don't give in to the crowd's opinion. Reputable analysts are not the best reference point either. The reliability of their predictions is insufficient. The importance of the analysis should not be overestimated as well. It is often wrong in the long run. And the most important principle is to be long-term minded. If you try to get rich quickly, you will lose. Long-term profits do not depend on some random factors but are determined by how good the business you invest in is. The power of the long-term approach is well illustrated by a chart I took from the book Stocks for the Long Run by Jeremy J. Siegel. Obviously, when investing for the long term, the first thing to do is analyze the company itself to at least roughly predict its future. The book Good Stocks Cheap can help you with this. There, Kenneth Marshall explains his approach to analyzing companies. If you think that analyzing markets and companies is too difficult, the following book will prove you wrong. But first, please like this video and support our channel by subscribing. It is important for us. Thank you. If anyone knows how to pick stocks, it is the American investor Peter Lynch. He grew the assets of the affiliated Fidelity Magellan Fund from $18 million to $14 billion. At times, the fund had more than 8,000 different stocks in its portfolio. The idea of his book, One Up on Wall Street, is simple. Easy evaluation techniques allow even a beginning investor to become an expert and make decisions no worse than Wall Street pros. Let me summarize the main conclusions from this book. Lynch encourages the reader to look for and hold 10-bagger stocks, which are stocks that can grow in value 10 times over. In order not to make a mistake in choosing these companies, it is necessary to study their prospects, competitive advantages, and development strategies. Lynch believes that stock prices are fairly easy to predict for a period of 10 to 20 years. Therefore, he urges you to always buy stocks of companies you believe in and then wait for them to grow over a long period of time. As for trying to predict the economy and short-term stock market trends, it is useless. Lynch also advises looking for stocks based on the who benefits principle. Simply put, it is a pick and shovel strategy. When during the gold rush, most gold seekers lost money, but those who sold them picks and shovels made a fortune. If you enjoy such guidance from a skilled investor, you can check out a couple of other books from acknowledged figures in the investment world. Proof that trying to predict market trends is useless is also given in a Random Walk Down Wall Street book. There, Burton Malkiel describes his theory, claiming that no one can predict where the market will go or which stock will rise in value. The author provides numerous examples from investment history to back up his arguments. For instance, if an investor with 10 grand invested in the S&P 500 in 1965, his portfolio would be worth $1,090,000 today. A different investor who invested the same amount for the same period in an average active fund would have only $817,000. That is, even professionals cannot outperform the market over the long haul, and the best way to invest is to follow the principle of diversification and keep assets long-term. The S&P 500 example would certainly appeal to the father of index investing, John Bogle. I recommend reading his bestseller, The Little Book of Common Sense Investing. Be sure to share the investment book you think is the best in the comments. The coming year seems like the perfect time for you to put all this knowledge into practice. But to be even better prepared for the coming storm, watch this video.